There's a specific moment, and I need you to picture this clearly, where you open your investment app, and for the first time in your entire adult life, the number staring back at you doesn't make you feel behind. It doesn't make you feel stressed. It doesn't make you do that thing where you close the app faster than you opened it. Because the number is so small, it feels like an insult. For the first time, you look at that number and your brain does something it has literally never done before in the context of your finances. It exhales. And here's the wild part. That number might not even be that big. It's not $1 million. It's not even close to retirement. By most standard financial metrics, it is still a relatively modest amount of money. But something shifted. Something in your head, in your chest, in the way you think about Tuesday morning, something changed. That number for a lot of people is somewhere around $50,000. And today I'm going to show you using neuroscience, behavioral economics, and a 1970s Japanese manufacturing philosophy that accidentally explains everything about how wealth is built, exactly what is happening inside your brain when you cross that threshold. And more importantly, why most people never get there, not because they can't afford it, but because the system that's supposed to help them get there is working against them in ways nobody talks about. My name is Slime Johnson, and this is Slime's Wealth Academy, the place where regular people get the financial education the system was never designed to hand us. Let's go! If you're someone who has been grinding away at your savings, putting money aside every month, watching the number crawl upward at what feels like geological speed, wondering if the sacrifice is actually going to add up to anything, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Because today we are going deep on something most financial channels won't touch. Not the math of saving $50,000, the psychology of it, the neuroscience of it, and the very specific, very real reason why hitting that number doesn't just change your bank account, it changes the way your entire brain operates. This is the video I wish someone had handed me during the years when I was doing everything right and still feeling completely, totally, cosmically broke. So stay with me. Port 1. The Kaizen problem, I want to take you back to 1950, post-war Japan. The country is in ruins, manufacturing infrastructure demolished. The economy is essentially starting from zero. And a group of American management consultants, sent over as part of a broader reconstruction effort, introduced Japanese factory workers to a philosophy that will quietly become one of the most powerful productivity frameworks in human history. They called it Kaizen. The word means roughly continuous improvement. The idea is deceptively simple. You don't transform a broken system through massive dramatic overhauls. You improve it by 1% every single day. Small, consistent, incremental change, compounded over time. Toyota adopted it, Honda adopted it. By the 1980s, Japanese manufacturing had gone from rubble to dominating global automotive markets. Not through innovation explosions, but through relentless, almost boring, daily marginal improvement. Now, here's why I'm telling you this. Because Kaizen also revealed something deeply uncomfortable about human psychology that nobody put on a motivational poster. The early stages of Kaizen, the first months, sometimes the first years, produce almost no visible results. The factory doesn't look different. The output numbers don't dramatically improve. The workers making the small changes every day can't feel the progress. And this created a specific documented problem that Toyota's management had to actively manage. People quit. Not because the system was failing, because the human brain is literally incapable of perceiving improvement when the change is gradual and the payoff is deferred. Sound familiar? Here's what this has to do with your $50,000. The journey to your first $50,000 in savings is almost a perfect financial replica of early stage Kaizen. You are making the right moves. You are doing the right things. The system is working exactly as it should. But because the human brain is unwired to require visible, near-term feedback to maintain motivation, the early stage of wealth building feels indistinguishable from doing nothing. And this isn't a personal failing. This isn't a discipline problem. This is your Paleolithic nervous system trying to navigate a modern financial instrument it was never designed for. The tragedy of Kaizen and the tragedy of personal finance is not that the process doesn't work. It's that most people quit before the process becomes visible. Toyota solved this by engineering external signals of progress, milestone markers, celebrations of small wins, ways to make invisible progress feel real. Your financial journey needs the same thing. And that's exactly what crossing $50,000 does. But we'll get to that. First, I need to show you the data behind why this number specifically matters. And I promise, this next part is going to feel like someone turned the lights on. Part 2, the data, meet the villain, okay? Numbers. Because I don't do feelings without math behind them. Let's start with what the Federal Reserve's 2023 survey of consumer finances actually tells us about where most Americans stand. The median American between ages 35 and 44, prime earning years, right in the thick of career building, has a net worth of approximately the 135,600. Sounds okay until you realize that number is almost entirely driven by home equity. strip out the house, and the median liquid financial assets, investment savings, the stuff that actually generates wealth passively, drops to somewhere between $8,000 and $15,000. That's not a typo. The average American household in their peak earning decade has somewhere between $8 and $15,000 in actual liquid wealth. Now compound this with a Vanguard behavioral finance study from 2022 that tracked middle income households, 50,000 to 75,000 annual income over a 20-year period. The households that maintained consistent investment contributions throughout the full 20 years ended with average balances of $271,000. The households that started and stopped, $68,000. Same income, same time, a quarter of the outcome. But here's the statistic I want you to sit with. And this is the villain of today's story. Researchers at the University of Michigan's Consumer Finance Survey tracked the savings behavior of American households over a decade. They found that the dropout rate, the percentage of people who start a consistent saving or investment habit and then abandon it within 5 years, sits at approximately 67%. Two out of every three people who stop. And the dropout rate is not evenly distributed across wealth levels. It peaks almost perfectly at the point where savings balances are between 5,000 and 25,000. That's the dead zone. That's the valley of despair, where the math isn't big enough to feel rewarding, the sacrifices are real enough to feel painful, and the gap between where you are and where you want to be is so vast that continuing can feel genuinely irrational. This is where the villain lives. Not in a bad market, not in predatory lending, though that's real, not even in stagnant wages, though that's real too. The villain is the psychological trough, the motivational dead zone that exists between zero and somewhere around $30,000 to $50,000 in savings. The place where the math is working, but your brain cannot feel it. Here's what most people don't realize. The dropout rate drops off a cliff, sharply measurably, once household savings cross $50,000. Not because the math changes dramatically, because the brain does. Part 3, the twist, what's actually happening in your head. This is the part I need you to screenshot or write on a sticky note or tattoo somewhere reasonable. In 2013, neuroscientist and NYU professor Elizabeth Phelps published research on what she called the financial threat response, the way the human amygdala processes perceived scarcity. Here's the finding that stopped me cold. When the brain perceives financial insecurity, not just poverty, but the feeling of financial insecurity, the amygdala triggers the same threat response cascade it uses when you're being chased by something that wants to eat you. The stress hormone cortisol floods the system. The prefrontal cortex, your long-term planning center, gets suppressed. And crucially, your brain's reward circuitry reorients itself entirely around short-term relief, which means every dollar you save instead of spend during financial stress is not just a mathematical sacrifice, it's a neurological one. You are asking a brain running emergency software to make long-term decisions. You are asking someone in the middle of a panic attack to calmly calculate compound interest. The wonder isn't that two-thirds of people quit. The wonder is that anyone makes it through. Now here's where it gets really interesting. In 2019, researchers at the Harvard Kennedy School published a study on what they called the financial security threshold, the savings level at which households measurably shifted from scarcity mode thinking to what they termed abundance cognition. The number varied by income level, cost of living, and household size. But across the full sample, adjusting for all those variables, the psychological shift consistently occurred when liquid savings reached approximately 3 to 5 months of household expenses. For the median American household spending roughly $500 a month, that range lands right around $16,000 to $27,500. Now, you might be thinking, Slime, that's not 50,000. That's way less. And you're right, the initial shift, the first and neurological exhale, can happen earlier. But here's the distinction that the research actually draws, and it's one almost nobody talks about. There's a difference between the relief threshold and the transformation threshold. The relief threshold is where your cortisol starts dropping, where the immediate panic begins to lift, where you stop checking your account balance the way you check a wound to see if it's still bleeding. The transformation threshold, the point at which long-term thinking genuinely, measurably, durably replaces scarcity thinking, requires something more. It requires what the Harvard researchers called cognitive surplus. Enough financial cushion that your brain has genuine bandwidth left over after managing survival to actually think about the future. And in their data for median American households, that level of cognitive surplus consistently emerged at liquid savings of $45,000 to $55,000, right around $50,000. This is why Charlie Munger said the first $100,000 is the hardest. He was talking about this exact inflection point, the point where the brain stops fighting the process and starts working with it. 50,000 isn't the finish line. It's the point where you finally get the full team on the field. Part 4, the present day. What this means for you right now. Okay. Let's get specific about what actually happens behaviorally, measurably in real households when savings cross this threshold. Vanguard's investor behavior data shows that households with investment balances above $50,000 are 340% more likely to maintain consistent contributions during a market downturn than households with balances below $25,000. Not because they're richer, the income levels in the study were controlled for, because the psychological relationship with the account has fundamentally changed. Below $25,000, a 15% market correction feels like a wound. It feels personal. It feels like confirmation of what the scarcity voice in the back of your head has been saying all along. This doesn't work for people like you. Above $50,000, a 15% market correction is math. It's a number on a screen that you know, based on 100 years of documented market history, will recover. Your brain has enough cushion, enough cognitive surplus to actually access that knowledge instead of being overridden by the panic response. This is the magnificent irony at the heart of personal finance. The people who most need to stay invested during market downturns are the people with the smallest balances. And they are the people whose brains are least equipped to do so. Not because they're weak or undisciplined, but because their financial position has literally suppressed the part of the brain that can think long term. The system has its thumb on the scale, and it has since before you took your first dollar out of a paycheck. Here's what the transformation looks like on the other side. I'm going to give you 4 behavioral shifts that researchers have documented consistently across income levels in households that cross the $50,000 savings threshold. Because I don't want this to just be inspiring, I want it to be a map. Shift 1, spending psychology changes. Below the threshold, most people spend to relieve stress. The weekend purchase, the restaurant meal, the thing from Amazon that you didn't need. These aren't failures of discipline, they're cortisol management. The brain under financial threat will seek relief mechanisms, and consumption is one of the vastest. Above the threshold, spending shifts. It doesn't disappear. You're not suddenly a monk. But the psychology behind it changes. Instead of spending to escape present discomfort, you start spending to create future options. The brain starts naturally distinguishing between consumption that expands your life and consumption that just quits the noise. Shift to risk tolerance recalibrates. This one surprises people. You'd think having more savings would make people more cautious, more afraid to lose what they've built. But the data shows the opposite. Households above $50,000 in liquid savings are actually more willing to make longer horizon investment decisions, take calculated career risks, and start businesses. Because risk tolerance isn't primarily about personality, it's about cushion. When you have a soft landing, jumps feel different. Shift 3, financial identity shifts. Below the threshold, most people's financial identity is reactive. They think of themselves as someone trying to get ahead, trying to catch up, trying to not fall behind. The mental model is deficit based. Above the threshold, the identity starts to flip. People begin thinking of themselves as investors, as builders. The mental model becomes asset based. And this is not a trivial shift. Identity based behavior is the most durable kind. People act in accordance with who they believe they are. The moment you stop thinking of yourself as someone trying to save and start thinking of yourself as someone who builds wealth, the decisions you make every day start to change. Shift 4, compounding becomes visceral. At $5,000 invested, a 10% annual return gives you $500. You can do the math, but you can't feel it. It doesn't move the needle. At $50,000 invested, a 10% annual return gives you $5,000 in 1 year, passively. That's a car payment covered for 5 months by money that used to not exist. That's a plane ticket. That's 3 months of groceries. It's real, it's tangible. And once compound interest becomes tangible, once you can actually feel the engine running, the entire motivational calculus changes. The process stops requiring willpower. It starts generating it. Part 5, the roadmap how to get without losing your mind. All right, enough theory. I'm not here to just explain the problem. Here's the map. Phase 1, acknowledge the dead zone. You are not failing. You are in the trough. The motivational dead zone between 0 and $30,000 is a documented neurological phenomenon. Every person who ever built wealth passed through it. Your only job here is to not mistake the feeling for evidence. The scarcity voice saying this isn't working, that's your amygdala doing its job. It's not a financial analyst. Don't let it make financial decisions. Phase 2, engineer your progress signals. Toyota solved the Kaizen motivation problem by building external feedback into the system. You need to do the same. Celebrate milestones that feel real. Hit $10,000, that's a real thing. Take a photo of the screen, tell someone, mark it. Hit $25,000. Celebrate proportionally. Not with a purchase that sets you back, with recognition that you have done something the majority of people around you will never do. You have made it through the deadest part of the dead zone. A 2021 study from the Journal of Consumer Psychology found that milestone-based financial celebration, deliberately acknowledging savings thresholds, increased the probability of continued saving behavior by 31% compared to households that tracked savings without marking milestones. 31%. Celebration is not frivolous. In this context, it is strategy. Phase 3, automate the behavior, not just the transfer. Most financial advice says automate your savings transfer. And yes, do that. Set up the auto transfer on payday before your brain can intercept it. But I want to go one level deeper. Automate the decision framework, not just the transaction. Write down physically on paper your savings rule. Something like every raise 50% of the increase goes to savings before I see it. Every bonus 30% goes to investments before I spend any of it. My savings rate increases by 1% every 6 months. When it's written and decided in advance, you're not making a financial decision in the moment, which means you're cortisol flooded. Scarcity mode brain never gets a vote. You made the decision when you were calm, when your prefrontal cortex was online. Honor that version of yourself. Phase 4. Understand what you're actually racing against. Here's the math most people haven't done. If you're 30 years old, putting away $500 a month into a broad market index fund averaging 10% annually, which is the S&P 500's rough historical average, you cross $50,000 in about 6.5 years. Now, I know 6.5 years sounds like forever, but here's what's actually happening in that account while you wait. At month 1, $500. At year 1, roughly $6,300. At year 3, roughly 21,000. At year 5, roughly 38,000. At year 6.5, 50,000. But then watch what happens to the rate of growth. Year 7 to 10, you go from 50,000 to 95,000. That's $45,000 of growth in 3 years, more than your entire first 6-year climb. Year 10 to 14, you go from 95,000 to $175. $80,000 of growth in 4 years. The first $50,000 takes 6.5 years. The next $50,000 takes less than 3. The one after that takes less than 2. The engine doesn't just keep running, it accelerates. You are not racing the clock, you are loading the spring. Phase 5, protect the threshold. Once you cross $50,000, treat it like a psychological asset, not just a financial one. Because it is both. Do not trade it for a car. Do not trade it for a renovation. Maintain 3 to 6 months of emergency expenses in a separate liquid account so you never have to touch the investment portfolio during a life crisis. Because the moment you raid the investment account, the moment you watch that number drop back below the threshold, you risk more than just the dollars. You risk the psychological shift. The brain that crossed $50,000 operates differently. Protect that brain. Part 6, the honest take. No hype, no doom. Look, I need to spend a minute being straight with you because this channel doesn't do hype and it doesn't do doom. It does honest. Here's what's real about the current environment. Interest rates are still elevated. The Fed funds rate, while beginning to ease as of late 2024, spent 2 years at levels not seen since 2007. High yield savings accounts are paying 4.5% to 5%. For someone in the early stages of wealth building, the dead zone I've been talking about, this is actually an unusual and meaningful tailwind. Your cash savings are earning real returns for the first time in over a decade. That matters. At the same time, the stock market is pricing in a lot of optimism. The Shiller-Cape ratio, the cyclically adjusted price to earnings ratio that smooths out earnings over 10 years, is hovering around 34 to 35 times earnings. The historical average is 17. We talked about this in a previous video. I'm not saying it crashes tomorrow. I'm saying there is less margin for error than there has been historically. And anyone who tells you the upside is guaranteed is selling you something. The honest play right now today is the same play it always is. Consistent contributions, broad diversification, an emergency fund that keeps you from being forced to sell at the bottom, and a long time horizon. What you do not do is sit in cash waiting for the perfect moment. Inflation at 3.4% is a slow tax on idle money. The 4.5% you're earning in a high yield account gives you a real return of barely 1%. That's not wealth building. That's barely treading water. The goal is not to time the market. The goal is to build a financial position so durable that market timing becomes irrelevant. And the first step toward that position, the step that changes your brain, your risk tolerance, your financial identity, and your daily relationship with money, is $50,000. Here's what I need you to walk away from this video knowing. The reason your savings journey feels impossible right now is not because you're bad with money. It's not because you don't earn enough. It's not because the market is rigged, though it's not exactly tilted in your favor either. It's because you are trying to build long-term wealth on a brain that is running short-term emergency software. And that software is not a character flaw. It is 200,000 years of human evolution doing exactly what it was designed to do. The difference between the people who make it through and the people who don't isn't income. It isn't intelligence. It isn't luck. It's who understood that the dead zone is temporary. It's who engineered their behavior to survive the trough long enough for the math to become visible. It's who treated $50,000 not as a number but as a neurological finish line, the point where the brain stops fighting the process and starts fueling it. That transformation is available to you. It is not reserved for people who earn more, who started earlier, who had parents who handed them the cheat code. It is available to anyone who keeps going when nothing seems to be happening, because something is always happening underground, in the roots, in the accumulating, compounding, silently multiplying base that your future self will one day sit on top of and wonder how it got so big. It got big because you didn't quit during the part that felt like nothing. That's Kaizen. That's compound interest. That's the whole game. Your $50,000 isn't a destination, it's a door. Walk through it. If this video shifted something for you, if you see your own savings journey differently after watching this, hit the like button right now. It genuinely helps us reach the people who need this most. Subscribe to Slime's Wealth Academy if you're not already here. We do this every week, no jargon, no gatekeeping, just the real mechanics of how money works and how regular people can use them. And drop a comment, where are you right now? Deep in the dead zone, almost at $50 K, already past it and nodding at every word? Tell me, I read all of them. I'm Slime Johnson, regular people, real wealth, no gatekeeping. See you in the next one.